So, when the government tells you, you really should do this, I don't know about you, but I'm thinking I should do the opposite. Good morning, welcome back to the weekly crypto review. So, first off, a little business. If you find this information valuable, be sure to like, subscribe, share this video. If you really think it's valuable, feel free to go to cryptocurious.tv/support. I've got my wallet addresses there. You can feel free to send me a little crypto. What I'm really interested in is FDIC Chair person Jelena McWilliams put out, this is March 24th, she put out this video basically begging Americans to keep their money in the bank. Don't go to the bank and take your money out. It's perfectly safe. It's safer in the bank than it is under your mattress. Yeah, okay. Why don't I believe her? Perhaps it's the fact that she felt she had to go and make this video. First off, understand FDIC, Federal Deposit Insurance Corporation. It was created after the crash of 1929 and the bank runs that followed. Banks went under in the early 1930s because everybody rushed out to them to get their money, and they ran out of money. Well, a week ago, the Fed, in their brilliant wisdom, decided to remove restrictions on reserves for the banks to hold. It used to be that the banks had to hold a 10% reserve, so that when you put your money in the bank, they don't put it in the vault. They lend it out. But they had to have a 10% reserve so that, one, it kept them from doing unlimited loans. They only loaned so much, as much as they had, minus 10%. But the other thing was it kept a balance in the vault so that people who went into the bank could be assured that if they said, I want to pull my money out, there would be money in the vault. Now there's no insurance now there's no assurance that the bank will have any money in its vault. They don't need to anymore. The Fed said you don't have to keep that reserve. So all of a sudden, the chairperson of the FDIC, the company that insures your deposits, goes out and makes a video saying, please don't go to the banks and take all your money out. Please keep your money in the bank. Yeah, okay, that doesn't sound fishy at all. On top of that, we have this guy, Neel Kashkari. When you see his name spelled, you're going to think it says cash carry, which is just humorous as hell. But this guy, he is the head of the Fed in Minneapolis. And his thing is, and then I will have both of these videos linked in the description. His thing is a 60 minutes interview, as you can see. He's telling America, because in 2008, he was the guy in charge of TARP. You remember the program the government started to bail out the banks? Yeah, this is the guy that was in charge of it. And he's saying in this interview that the only mistake that the government made at that point is that they didn't go all in. They didn't print enough money. If only they had printed enough money, the 2009 recession would never have happened. Really? Do you really think we're that stupid? I mean, I understand. Either you're an idiot or you have a vested interest in lying to the American people. I'm going with the latter, not the former. I don't think a stupid person could get to his position. I think he understands exactly what's going on. I think he is putting up a smokescreen, smoke and mirrors, to fool whoever he might be able to. Those who are gullible enough to believe that the government is here to help. Because, again, he knows, just like we all do, this is what the government's going to do. They now have the ability to print unlimited amounts of money, and they've already said they're going to. So they are all in this time. Whatever you think, the government is all in. They're going to print and print and print to try and keep this debt bubble inflated. Problem is that it's already got a hole. It's got a hole that's growing. Eventually, it's going to pop, and they won't be able to print enough money fast enough to keep it inflated. When that happens, we're seriously going to be in a bad depression. And I'm afraid that's what's going to happen this time. Time will tell. Am I right? Am I wrong? Only time will tell. So, what do we got for assets? Well, everything is down. Gold is actually running fairly sideways, okay, at 1636.50. Okay, fine. Silver is down to 1452. Both of them are down from where they've been. Problem is, physical gold and silver, you can't find any. No one is selling any. And if you happen to find someone who actually is willing to has some and is willing to sell it, you're paying a premium for both. You're not paying the spot price. Spot price is how much gold or silver is worth in an ETF. That's and understand that ETFs are derivatives and they suffer from hypothecation, which is, for example, they have 1 ounce of gold, but they sell it to 5 different people. That's rehypothecation. 5 different people have ownership claim on this 1 ounce of gold. Okay? That's why everybody says get physical gold. If you're holding it in your hand, or you've got it in a trustworthy vault somewhere, you know that you're the only owner. Well, if you're trying to buy some, and you are lucky enough to find someone who has it, they're selling it at a huge premium because no one can find any. So you're not going to find gold for $1636.50. You're not going to find silver for $14.52. It's going to cost you more. While that is the base price, anybody who's willing to part with them is going to charge you a premium. Yeah, I'll sell it to you, but you're going to pay my price, which is supply and demand. There is no supply. There is a huge demand. So yeah, absolutely. That's going to start driving the price up. Okay. The other thing is we've got a gold-silver ratio of 112.7, which is not quite record territory, but it's just below. And what this means is that in order to buy 1 ounce of gold with silver, you need 112.7 ounces of silver to buy that 1 ounce of gold. That's incredible. And I'm with Mike Maloney. I think it's going to go up higher. I think you're going to see a gold-silver ratio upwards of 150. Now, that does us no good at this point. It really doesn't. What it does do is it gives us an indicator of how far out of whack the price of silver is compared to gold. Because normally, historically, it's been a 10 to 1 ratio, 10 to 20 to 1. So what that means is that historically, it took between 10 and 20 ounces of silver to buy 1 ounce of gold. That's historical, okay? Now, we're nowhere near that. If it gets back down into that territory, and Mike's saying that he expects $10,000, he expects $10,000 gold at the low. It could be much higher. Well, if you're looking at a 10 to 1 ratio, that's $1,000 per ounce for silver. If you've got silver, you're going to be very happy. So, what do we got as far as the other assets? Well, Dow Jones is down compared to where it was a month ago. What I've done is I'm looking at how far down it is. I took the height and I dropped it down to where we are now because we have recovered somewhat. So we've dropped 26.71%. That's what this drop has been. It really was a 30% drop. It dropped much farther down here. But we're looking at where are we now. And if you know anything about Japanese candlestick charting, you'll recognize this as a bullish engulfing pattern. Absolutely. We're seeing it's going to go back up. Well, yeah. The problem with these patterns, they give you an indication of direction. They don't necessarily give you an indication of how far or how long. This is a dead cat bounce. This green candle here that we had last week is due entirely to Congress passing this stimulus plan that they did. Well, it's no stimulus. It's not going to stimulate me, you, or anybody else. If, like me, you made 6 figures in 2018, you're not getting anything. If you made under 6 figures, you're going to get a $1,200 check and another $500 for every kid that you can claim on your taxes. Okay, so $1,200, $1,700, $2,000. How long is that going to last you? It might pay your bills this month, maybe. So, but it makes Congress look like they're doing something. They aren't, but it looks like they're like they're doing something. Unfortunately, as I showed you in an earlier video, that's about $500 billion out of the $6 trillion that they have offered. Who's getting most of that? Businesses who spent the last 10 years taking their profits and buying back their own stock so that they could inflate the price of their stock to make it look like they were more valuable than they really are. And thus they don't have the money in the bank to survive this now current lean time. There are exceptions. Companies like Apple, Berkshire Hathaway, they're sitting on mounds of cash. They don't need a bailout. They've got plenty of cash to spend. Tesla is another one. Plenty of cash to sit through this lean time and make product. They may not sell a whole lot, but they can make it. They can pay their people to come into work. They don't have to lay a bunch of people off. So they're going to do okay. It's everybody else. Everybody who needs a bailout, they're not running their companies well enough to deserve to survive this. Okay? So this is a dead cat bounce. The stock market dropped by 26.71%, which is actually, at this point, better than crypto, because crypto's down. I did the same thing with this. Let's go here. Crypto is down 39.05%. So really, stocks are doing better than crypto at this point. Okay? And I stress, at this point. Looking at this chart, I see an inverted hammer right after a spinning top, both of which are indications that the trend is going to reverse. Well, the trend is down. And this also is a weekly chart. So we're looking at 3 weeks down and then a reversal signal and then followed by another reversal signal. That tells me that the price is going to go up significantly. Again, it doesn't tell me how far or how long, but we've got two indications, one right after the other. One is, it's a mediocre signal. Yeah, I think it's going to, but this one is a much better signal, and the fact that they follow each other indicates that price is going to go up. And again, this $10,500 price point is resistance. Chances are it's going to bounce off. If it bounces off, I doubt it's going to drop this far unless something happens. Unless something drastic happens, I don't think it's going to drop like this again. I think it's going to be a much shallower dive because that's what it does. It hits resistance, it bounces off, comes down, gathers strength, goes back up. That's the way the market works. Absolutely. Now, there is a chance, and it's certainly a good possibility, that as the price goes up and gets closer to $10,000, that very well could attract more money into the market, and we could blast through this $10,500 mark. We absolutely could. Will that happen? Your guess is as good as mine. Those are the two possibilities, but I absolutely see it coming back up here, possibly rebounding. If it's got enough strength, it'll blast right through, but then we've got this other one at 11.5. Same problem, resistance. It's going to depend on volume. How big a volume are we going to have? We've had relatively low volume on our up days. That's been the case so far. That's fine. I expect that at the Bitcoin halving, we're probably going to be around $10,000. I don't think we're going to be up. If we're above it, it's going to be just above it. Okay? And remember, we've got the Bitcoin halving in 46 days. Okay? What does that do? Well, if we look at the stock to flow ratio, this is a comparison of how much Bitcoin is in the market, how much is available versus how fast it comes out into availability. And because it is a mathematical algorithm that gives us Bitcoin, we know that Bitcoin is coming out at a certain rate every 10 minutes. So a certain amount every day. And we also know that in 46 days, that amount is going to drop in half. It's going to be cut in half. That causes the line to come up. Yeah, we're below the line right now, but we've been there before. We've been farther below it many times, okay? This is not the end of the world. But as we get to this point, we're going to start climbing up. The stock to flow ratio says that the price must go up. Well, by the time we get to, let's see, where do we want to go here? We want this to be at, come on, April of 2021, so next year. We're looking at an $88,000 Bitcoin. Okay? That's spectacular, but that's not the end. Because as you'll notice, every time that we've hit this peak where it comes up, the price has always gone overboard. Well, okay, that means 100,000, 200,000, 250, 300, 400,000. All are possibilities. No one knows where it's going to go, how high it will go. I will say that it will not stay up there very long. Wherever its peak is, it's not going to stay there very long. That's why I've got let's pull out here a little bit. That's why I've got my bubble pop indicator. It's going to tell me, as it did back here in 2017, it's going to tell me when to pull out. How close to the top are we? It's going to tell me when we get there. We're nowhere near it at this point. Okay, but believe me, I'm going to be watching that very closely as we get up to this $100,000 or above. I'm going to be looking at it very closely. So, yeah, 46 days, I think, is where we're going to start seeing some action. Next year, beginning of 2021, I think is where we're going to start seeing price of Bitcoin above $20,000. That's going to get all of the cable news channels talking about it on a daily basis. That's going to attract a lot more people into it because it's the one asset that's really doing well. Gold will do well, silver will do better. Bitcoin, I think, will do best. And because you never really hear about gold and silver on the cable news channels, which is what everybody's watching, you do hear a lot about Bitcoin. And I expect that 2021, we're going to see a massive ramp up in price of Bitcoin. And I think we're going to see it go way up. Anyway, that's what I had for you this week. Until next week, keep hodling.